Hey everyone, it is the morning after the Federal Reserve's latest interest rate decision. What we saw last night was a 50 basis point rate hike. We have also seen, or they told us that they were going to begin trimming their balance sheet on June the 1st, starting with a cap of $35 billion worth of treasuries a month. $17.5 billion worth of mortgage-backed securities a month, which is then going to be doubled after 3 months. So, it's quite a hawkish step on face value when you don't take everything into consideration. But we live in a funny world at the moment where a 50 basis point rate hike and a run off of the balance sheet like that is considered somewhat dovish. Now, we did have a pushback in the press conference from Jerome Powell post the decision. He did say that they are not actively considering the 75 basis point rate hike that some market participants had come to expect, and that in fact just two more 50 basis point hikes could do the job. So what we were speaking about yesterday, there was the reactions that we expected to see yesterday proved correct. We have had that pullback in the dollar. We've had a move higher in euro dollar. Stocks did move higher off the back of the release, and we did fail to breach 3% on the 10-year yield. We had multiple levels all over the place, preventing that from happening. And then we also got the I wouldn't say dovish tilt, but a disappointment on a hawkish surprise. Not a disappointment. We didn't get that hawkish surprise that some market participants were predicting. Sorry, which it kind of thinks, have the Fed peaked in terms of hawkish surprises? I'd find it difficult how they turn even more hawkish from here on out with what they have said. They have outlined the rate at which they are going to trim the balance sheet for the next 3 months, when that's going to begin, and then the 3 months following they're going to double that. So they've outlaid their what they're going to do with that. They have said that they are not actively considering the 75 basis point hike, and that 2 rate hikes could get the job done. So that is not overly hawkish. That's not over the top in terms of hawkishness. That is a bit of a pushback on what some market participants were led to believe. Now, as we come across yesterday, we were looking at these levels. This big resistance level on the dollar index, looking at this big support level on euro dollar, and both have failed to be breached. Now, we did see a bearish engulfing posted yesterday on the dollar index. We did see a bullish engulfing posted yesterday on euro dollar, and it remains to be seen how then that reacts going forward. We have seen stocks going to a little bit of a lower time frame on stocks. See this support level down the bottom, a level that we wanted. I personally wanted to see broken was this level across here, and we've actually rejected off it pretty neatly. So, in terms of massive market moves, we've not got that. We've not got that clean continuation into this morning, which you would hope for off the back of an interest rate decision. Markets seem a little bit undecided as to what they want to do. Again, because markets have taken a 50 basis point rate hike and a trimming of the balance sheet as a dovish kind of step. So, bit of a difficult situation to be in for the Fed. With inflation rising, but also that's been complicated with the contraction of the U.S. economy in Q1 of this year. So the Fed are caught in between a rock and a hard place. We know that. We knew that. And they have come out and they've played their hand as such as to what they're going to do going forward. So, in terms for us to continue this move after what they've said yesterday, they're going to have to come in over the top of what they've initially done, and they didn't do that last night. Doesn't look like they want to do that in the future. So potentially we are finished with hawkish surprises from the Fed going forward, which would then mean we would have to be dovish, and we've had this kind of assault higher, as you can see in the dollar, that has showed no signs of slowing down until yesterday, until the past few days. So remains to be seen how that plays out going forward. Coming back to yields for a second, 3% failed to be breached on the 10-year yield. The 2-year yield is more what we want to be looking for in terms of short-term interest rate adjustments. Bring this down the time frame. We're still printing higher highs and higher lows. We're still grinding higher. Failed up at 2.8. Still printing higher highs and higher lows. So that's something we need to keep in the back of our minds. But if that starts to drop and we do get a break down below this level across here, that would be significant for me and something I will keep my eyes on. I'd like to see stocks above 43.10 before being confident that this move can continue. And then the dollar index, I mean, it's technically still in an uptrend until we get through this level here. So we've got a bit to go before we break through that. You'd want to see it kind of closer back down towards 100. Might get some tradable opportunities off the back of that as well. Euro dollar, a little bit messy in terms of the price action down around at this level. Always is against those higher time frame levels, but we have broken across. We have broken through these highs across here, which for us is a positive. Technically is a positive. We've retested it and it looks like a bit of a decent level to want to get this to continue. Whether it does continue or not remains to be seen. It's not something we know and not something we can figure out very easily. We've got to wait for some certain things to align, for some levels to break, for price to give us confirmation that it's going in that direction, and then we can align the fundamentals with the technicals and look to take advantage to try and find some good trading opportunities.